Let's start off with the small caps. What's your view on the small caps? Once a Trump trade, we just hit on some of the big inflows following the election, a definite shift when it comes to sentiment since then.
Yeah, I think the link between the Trump trade and small caps is really seen through the eyes of the economy. So the view was that the economy would be accelerating a bit. That's good for small caps. The view was also that rates would be coming down, and that's required for small caps, which have a bit more sensitivity to financing activity. So I think it's a bit of a rally delayed. There's some policy uncertainty at the moment. We've been seeing some economic data that's perhaps not as encouraging as investors were expecting. And so it is a bit of a rally delayed. I do think small caps will come into their own later in the year. But for now, this is a very choppy market with a lot of rotation going around, and small caps are bearing part of the brunt of it, given some of the concerns over the economy and the rate backdrop.
Well, I think that's the word you just of the word of the day maybe today, choppiness. With this current environment, I mean, what would you advise some of your clients to do right now? Are there safe places to put money? Are there places that you see genuine opportunity for upside right now today?
Well, one of the things that's really interesting is we think diversification is starting to work a little bit, not into small caps, but within the S&P 500, for example. The equal weight benchmark has been doing quite well this year. Within technology, for example, the average technology stock is outperforming the tech sector quite significantly. And so it does seem like investors are looking for some of that diversification to protect themselves against some of these policy risks. And so that's one of the things that we're looking for, is just being very careful in terms of selection, staying high quality, but also maintaining some of that diversification. Healthcare is an interesting sector as well. It's an area that has had a lot of problems in terms of profit margins, recovery from the pandemic. Those margins seem to have stabilized. It's a sector that we think can cut out some costs and increase productivity pretty significantly. So that's another area that looks interesting to us.
All right, Robert, one other area we have to talk about are bonds. We've seen a lot of investors go to bonds. That's largely why we've seen yields decline. Another reason for the yields declining could also be concerns about economic growth due to tariffs and other policies. How are you viewing the bond market? Is there one area where you see that as attractive? Do you actually believe that is a safety play?
Well, it is a safety play. It sort of showed itself to be that way late last week. It's discouraging in that the bond rally came about for the wrong reasons, not inflation coming down, but rather concerns over the economy. We're not terribly concerned about the economy. We think it's a downshift in growth, but still will be positive growth this year. And I think it will be a long move towards lower rates in bonds. So we're pretty comfortable with the 10-year, but think it's just going to take a lot of time to bring that bond rally into play. It happened a little bit more quickly for the wrong reasons last week. But we think the path is lower for rates over the longer haul.
What about international markets? We're going to spend a lot of time talking about Germany today after their elections. How do you view international markets? Are you seeing opportunities there for the rest of the year after some outperformance compared to the U.S. markets to start the year?
There are some good opportunities there. I think some of the economic and demographic challenges remain, but there are a lot of great companies with good valuations overseas. And so we've been encouraging investors to maintain that diversification. That's starting to come into play this year. So that's another example, I think, of this, maybe call it hidden rotation, where you're not quite getting the rally super broadly, but within the S&P and towards overseas, you're starting to see some of that rally. Some of the stabilization in the dollar, I think, helps too. Not as much dollar strength here. And that helps the non-U.S. sector as well.